Steve, you're in a great position in order to judge what investors think about this rally that we're seeing, even though you're focused on fixed income. What do you think investors are looking for right now? Safety, or are they getting greedy?
Well, I think investors are being somewhat cautious. We've seen most of our flows this year go into very high-quality exposures. So last year we took in over $100 billion in the U.S. Most of that went to treasuries. That's playing out the same way this year. We've taken in around over $40 billion this year, and 30 of that has gone into treasuries. Something that might surprise the audience is that a third of that has actually gone into our longest duration treasury, TLT. So investors do appear to be moving out somewhat in duration, and I think that is basically a function of two things. Number one, yields are attractive for the first time in quite some time, but secondly is somewhat of a hedge maybe, because we're still going to see quite a bit of volatility as we get this data in, as we try to understand what the Fed's doing. So I do think investors are seeking some ballast in their portfolios, even though equity sentiment does appear to be turning more positive.
And Steve, just to put some numbers on that, on those TLT figures, it's pretty outstanding. I see TLT, according to Bloomberg data, taking in $10.7 billion so far this year. Then you think about what it saw last year, $15.7 billion going into TLT. Where is this money coming from? Are these new investors to the ETF landscape maybe taking this money out of mutual funds? Or where do you think this demand, in terms of the billions of dollars, the record flows that we're seeing into this product, actually coming from?
I do think it's a combination of investors. So we do see a lot of model-driven flows into TLT and the other maturity cuts, but we also see quite a bit of institutional money now trafficking in TLT. So the options market on TLT has heated up quite a lot in the last couple of months. We've seen some really interesting trades go through the market, and those are institutional investors and potentially even traditional fixed income players that are starting to recognize the utility of those products and the options on them.
So, Steve, that's a great segue. We're going to ask you about HYG. The options on HYG are, you know, I've been tracking this for years. You know, this is a chart that just goes up and up and up. What's your take on this, that options on HYG are sort of replacing, or the new CDX? This is the way to hedge yourself from a credit event. Do you see that, HYG stealing market share from CDX?
We do see that. We hear it. We hear that from both clients and broker-dealers that in terms of just a overall portfolio hedge, I mean, if you step back and think about what an option on HYG or LQD or TLT actually is, it's an option on a bond portfolio. So if you are managing risk in your bond portfolio, that's about as close as you can get to the risk that you want to hedge. So it makes sense that these products have become a lot more popular relative to just a pure spread option, which is what CDX options do. So we're seeing increasing interest from credit players and, as I mentioned before, even institutional rates players in these options markets.
One other ETF of yours that we track a lot is IUSB. This is the Universal Bond Index. And to me, this is a better version of the AG. It's got a little dose of high yield international. This is what bond managers do to beat the AG easily. This one has it in. Bond managers' beat rate goes down. I think it's going to be bigger than AGG someday. What do you say?
We have seen very good flows into IUSB this year. I think we've seen about $4 billion. AGG's taken in about $7 billion. So it's keeping right up. AGG is a monster fund. It's $90 billion. However, IUSB is over $20 billion now. So it is growing very rapidly. I do think, Eric, a lot of investors share that view that it is a good total bond market exposure. It includes not only the ag components, but also EM and high yield. And so it gives you a totality of exposure all in one ticker.
Are the younger investors, you think, gravitating towards ETFs? I have always thought that they would naturally do so. And when I talked to some institutional investors this last week, they pointed to, trading apps that don't maximize ETF usage. Is this part of, you think, the new frontier?
I do think there's a very broad trend that we think is helping to propel this market. As you know, we've been very vocal about where we think bond ETFs are going. We think we'll hit $2 trillion this year. We think we'll hit $5 trillion by the end of the decade. Part of what is propelling that is what we refer to as the modernization of the bond market. And we just touched on it a little bit, which is this idea that a recognition that these are very powerful tools to navigate fixed income, either taking risk or hedging it. We do think the next generation of investors are really grabbing onto that. And we're seeing that generation of portfolio managers really embrace these products.
I also wanted to get your thoughts on a trend that's really developed. It feels over the past year when it comes to fixed income ETFs, as that market gets bigger, you've seen certain products come to market, such as the U.S. Treasury 3-month bill ETF, ticker T-bill, which just tracks T-bills. Launched less than a year ago. It's over $1 billion in AUM. And also Bond Blocks has had a lot of success with sort of their specific maturity-focused ETF lineup as well when it comes to the fixed income universe. Do you see sort of investors having that demand for these more specific products? We talk about the TLTs, we talk about the AGs of the world, but what are you seeing when it comes to maybe more focused and carved out fixed income products?
We're seeing this in our suite as well. So our iBond suite, which is our defined maturity suite, is now sitting over $20 billion. We've taken in over $5 billion year to date, and half of that is actually in Treasury. So we're seeing this desire for precision and granularity in different ways, and that's a trend that I think is going to continue. I think for an entry investor, someone who's not familiar with bond ETFs, a defined maturity ETF is a great way to sort of get into the market and understand the exposure, because it looks more like a traditional bond where it rolls down and matures.